can I show you a real quick chart? As if you get a choice of what I show you. You got no choice. We're looking at GLD/SPY. Check this out. This is a cool chart. You can build on TradingView. You can compare, just like you can with a currency pair, you can compare two charts. So what I've just done is the gold chart versus the S&P 500. And you can actually see that gold has been very strongly outperforming the S&P 500. You love to see this, especially if you're in longs like myself, but really nice gold outperformance here recently. You've seen stocks continuing to move lower. And the reason I bring this up is because, you know, as someone who benchmarks my own performance against the S&P 500, obviously, preferably, I want to be in charts that are moving better than the S&P 500, right? If you're going to generate outperformance on the S&P 500, you really have two ways to generate outperformance. Let's say yellow is the S&P 500, right? If this is the S&P 500's performance, right? Let's say that's over a couple years of time. If you're going to outperform, and this is the goal. If you're a trader, you may have a different goal than me, and I'll talk about different goals in a second. But if you're a trader, the goal is to outperform passive investing. And the most notorious example of passive investing is to buy the S&P 500 or the SPY, right? If you buy the S&P 500 and hold it, typically in good times like we've had in the last 20 years, 10% per year passive income is incredibly good. That is what you get, you know, historically. Now, I want to clarify, you don't get that it's not guaranteed. You could have 10 years where the average gain on the S&P 500 is 2% per year. We've just been living in a time where stocks have been exceptional in terms of their returns. But my point is, I like to benchmark my performance against the S&P 500. And you can outperform the S&P 500 in a couple different ways. On the way up, if you want to outperform, let's say that green is our personal performance. So let's do this. So this is SPY, right? So if I'm making up a theoretical example. S&P 500, it's returning somewhere around 10% per year, right? So if you're returning 10% per year by holding the S&P 500, of course, like I said, some big assumptions there. You've got a good stock market right now. This is a really good 10-year period to look at. You can outperform in a couple ways. You can outperform by having bigger returns in up periods. And if you're investing that way, you're probably investing in technology. But the problem is when the markets dip, you can easily underperform drastically, right? Because tech stocks have been getting killed way harder than other things recently. So if your portfolio is all technology, right, and you're trying to outperform, well, then what you really want to do is you want to try to, when markets have really good periods, this is my personal philosophy, right? You want to be long technology. I say you, the proverbial you. I want to be long technology stocks when they're on sale, but I really don't want to chase them off a cliff, right? You have to be careful with tech stocks and high risk stuff. What I've done here recently has been, I've pretty much taken a lower beta portfolio. And what that means is I'm holding things like gold. I'm holding things like value stocks, things like that, right? Which in the down period will still decline, but they may not decline as sharply or as horribly as the broader market or tech stocks. So I've moved a lot of my funds out of high growth tech stocks for the time being, and I've stayed kind of risk off, right? Being risk off has allowed me to quote unquote outperform so far year to date by being less exposed to risk. It's kind of a hard thing to explain, but basically stuff holds up better or worse in crashes, right? Tech stocks get destroyed in crashes. They can be down 70%, 80%. Everybody loves them when they're going up. Everybody hates them when they're going down, right? So we've had a tech sell-off here recently. And so my point is right now I'm holding a lot of gold, which is leading to the outperformance in my portfolio this year so far, right? Gold has been holding up well while the stock market has dropped. Does that make sense?
Market analysis, free trading courses, edge finder data, and special offers. What do these things all have in common? They're all available for you right now inside of our free Discord. You can click the link down in the description below to join the free Discord today and get access to all of this and more. Stay up to date with all the latest trading information and A1 content. And if you want to upgrade to our Gold VIP Discord that features every single trade that Trader Nick and our other professional analysts take, you can find the links for that in the description as well. So don't wait, go check out the free Discord today.
Again, you can outperform the market by taking high amounts of risk, and if it works out, and if you're buying like high growth tech stocks, those are high risk stocks. If the market's good, you'll likely outperform. But if the market's bad, you will drastically underperform, right? So you have to be careful where your exposure is. So for me right now, I've been talking about how I am positioned in gold, and I'm thrilled that I'm in gold, even if it's going sideways. Sideways is great when stocks are getting crushed, right? So again, relative performance wise, I'm okay with being in gold and sitting around and waiting. Being bored waiting for gold to make a move is the greatest circumstance I could possibly be in right now, as opposed to stocks, right? If I'm sitting in gold, I'm saying, look, it's not really going anywhere. This is kind of boring. I will take that all day long rather than just being super long the NASDAQ as it continues to crater, right? So you got to be careful with NASDAQ. It is one of my favorite things long-term to trade and invest in and find good stocks in. But when it gets overvalued and the air comes out of the balloon, it can be a violent correction. Take a look at the NASDAQ here. So far, from the peak to trough, we are looking at about an 11.5%, 11% decline. The thing is, it's very common for the NASDAQ to see 15, 20% pullbacks, even in a strong bull market. So, is the NASDAQ a buy right now? Maybe. I mean, you're sitting at some pretty key long-term levels of support. But systematically, I don't have the right setups to really get long the NASDAQ, right? Technicals look good, but technicals are not the only thing I trade off of. If we take a look at the US economic heat map, still a lot of red in this chart. You got high inflation. This week, we get CPI numbers and PPI numbers. I'd like to see how those fall. Is inflation coming down, or is it still sticky and rising? You have to be really, really careful with what that looks like, right? If inflation keeps rising in the face of slowing economic data, last week we had non-farm payrolls slightly missed. It wasn't really a terrible NFP report. ADP, however, was a miss, right? We saw a big miss in ADP. That's the private payrolls. JOLTS job openings also missed. Unemployment rate went up, not by a lot, and we're still at 4.1%, which is a very strong unemployment rate. But my point here was showing you this is that, okay, the US economic heat map is not as, impressive as it perhaps once was. So to me, that cooling economic data continues to favor gold, which is why, like I said, my primary positioning right now, I am long gold, and I have a stop loss below these lows. If that gets taken out, I will reevaluate the trade, stop out of the position. So if we drop here and fail at support, I'll stop out of gold and look for a possible re-entry back here at the previous all-time high around 2,800 to 2,780, somewhere in that range. Again, as long as we continue to have edge finder confirmation, that might be a trade setup for me. I'm also watching some currencies right now. Pound US dollar. I'm curious to see how that one's looking today. Let's pull up the pound. Here's the British pound. You can see really clean price action breakout here to the upside, looking really strong. Watching to see if this thing can pull back this week. So if you get a pullback in the pound, I may look for continued upside on this one. So I like pound US dollar to the upside. Let's see what else we have. Russell's getting a bearish reading. Dollar Swiss, bearish. Dollar yen. Yen cross is still mostly getting bearish setups here on the edge finder. Whoops. Australian dollar against Japanese yen. Look at the Aussie yen. This is such a very strong downward trend. on the daily chart too, right? So that's a pretty key. You had this little retest here intra-week last week for Aussie yen. Sellers came in, hit that one back down. Most yen crosses look pretty weak to me right now. Aussie yen getting a very bearish reading on the edge finder. So pullbacks on that one could be interesting. I traded Aussie yen a couple times this year already and have had some pretty good success with it. We'll see if we can get another trade on that. You know, we're looking at the fundamentals which drive all of these markets, right? You may have a preference, a favorite thing, right? Most people do. Most people like to trade a specific thing, but and I do have my favorites, but I'm pretty agnostic to what kind of market we're in because I can trade lots of different things, right? I can trade currencies. They're all the same. It's just different names, but you're really trying to figure out, spot fundamental trends and how they could impact certain charts that we're watching, right? So like I said, I like gold and silver right now as bullish opportunities in the markets. We'll see if I can continue to spot some opportunities there. On the bearish side, yen pairs still look pretty weak to me. Indices, I'm kind of staying neutral. Although, check out this put to call ratio really quick. I do think that this is really worth keeping an eye on right now. And this is why I personally am not going to short the indices right now. If we take a look at the put to call ratio, you can see that we have a very high put to call ratio. Now, when the put call ratio gets extreme to the upside, what does that mean? Well, we've selected for S&P 500. For those of you who have the edge finder and you navigate to the put to call ratio chart, you'll also see that you can select oil, silver, S&P 500, QQQ, which is NASDAQ, gold, or DIA, which is the Dow Jones, the diamonds. You can select any of these charts and you can look at the options market volume for puts versus calls. And that is, to me, one of the most powerful sentiment indicators available to any trader. What we can see here is that recently puts have been in high demand. You know what people are feeling in this market? They're feeling fear. They're scared. People are nervous about the uncertainties of tariffs and the fear around whether the Fed's going to do this or that, or are Trump and Trudeau going to figure it out, or there's going to be a full-blown trade war. There's so much uncertainty in this market, and you can see it expressed by the market in the put to call ratio. So the put to call ratio, again, we've built tools for this to keep an eye on it. When it gets really low, everybody's euphoric, everybody's excited, everybody's optimistic about the markets. When everybody gets pessimistic, it goes the other way. Right now, I'd say you're sitting in a pretty opposite of euphoric state. People are terrified of this market. So the reason I'm not interested in shorting the S&P, shorting the NASDAQ, shorting the Dow Jones is because that's the popular trade right now. If you need more evidence of that, take a look at the AAII Investor Sentiment Survey, and we can see that investors have marked feeling very bearish in the last 2 weekly reported surveys. Almost 60% on both weekly reported, 60% of people feeling bearish. That is very high. So what does that tell you? Does that tell you go out and buy the stock market right at this moment? No, but it does, in my view, tell you that if there is one spark, one glimmer of good news in this market, take, for example, maybe a good CPI print, maybe Trump and Trudeau figure something out, anything like that, the market on a dime could be up 2-3% like that, right? So to me, if you're a bear in this market, it doesn't mean just if you're bearish on this market right now, the stock market specifically, or you're, bearish on the U.S. economy and you're bearish on the dollar, right? You can look at these things and you say, okay, well, if everybody's in that camp, let me just dial it back. Let me calm down. If you're bearish, right, you wait for these extremes to at least chill out a little bit. Let's say this week you get something like this. Maybe bearishness cools off, people get excited. Then there may still be the bearish opportunities out there, but you're not trading into the crowd. Does that make sense? Type yes in the chat if that concept makes sense. With sentiment, my opinion, you don't want to be chasing the extremes, right? So getting super bearish on the stock market right now, in my personal opinion, as always, is maybe a mistake. If you're bearish, that's fine, but maybe wait for some of the bears to kind of jump off the bench, right? Then maybe there's some downside. Maybe we see another leg lower. There is a lot of, kind of repricing here of how many rate cuts we're going to get this year. In fact, I pulled up the watch tool. What we can see is that the bond market is pricing in at this time 1, 2, 3 to 4 rate cuts this year. Small probability, but a possibility of rate cuts. Well, actually, I'm sorry. This is 3 in 2025 and then more in 2026. So up to 3 this year. Do you think that that's just? Do you think that's overzealous? Do you think do you think we probably only see 1 or 2, or do you think we can still see 3 rate cuts and the dollar still be strong?
I think what the market is doing is getting ahead of itself. And because this is just belief. There is no concrete proof in that we're going to have a 3.5%, 3 rate cuts by the end of this is December 25. This is just what they're hoping, or what their data is preliminary telling us what to do, but it's not really reality, because we haven't seen anything other than GDP now being forecasted to be negative. NFP was great. CPI is about to come. We don't have any numbers yet that is 100% Trump's kind of presidency in the second term. That is actually only him. What do I mean by that? We need to go. Well, it went in February. Any numbers that comes out from February in March is kind of like his term, and what comes out in March, so that would be in April for March. That is after all these new tariffs comes in. Then we will see the immediate effect of tariffs, or whatever he has been doing. But the long term, what happened during COVID when we had all these container ships not being able to dock, that was a long term or a longer term issue. Then if that happens, that's kind of what I'm talking about, is we have to wait for the longer term effects also to come in, like a year down the line, of the effects of what is currently happening. And so market's pricing in the next 3 months, we're going to have less activity. So I feel like they're just going for one idea and then see if it sticks or not. And then we'll have a rebound of dollar if it doesn't.
Yeah. Well, so I want to talk about this with you too, Ivan, and I think we might be having screen issues again with StreamYard. So hopefully you guys can see my screen okay, and Ivan's screen, but StreamYard has been giving us some issues. But I want to talk about this thought too, because there's questions about if there is in fact a Trump and Fed put. What I mean by that is, if you get a substantial slide in the stock market or the economy, is there a point at which the Fed or Trump steps in and makes drastic changes to try and save the day? They call that the Trump put, right? Buying puts or Powell put, right? Buying puts essentially as protection. But I want to talk about the Fed for a second, specifically the Fed put, right? Let's say you keep seeing inflation sticky, but then you get jobs data start to roll over. We had ADP numbers come in pretty poor last week. Unemployment rate went up. NFP was okay. It was flat. But let's just say in the next few months, we see jobs data continue to deteriorate. Maybe the efforts of Doge do end up really hitting the labor market, and we see that start to cool. If that happens, where do you think the Fed, do you think the Fed acts on jobs, or do you think it acts on inflation? Or do you think it does nothing? Like the Fed, so if you have stagflation, right, this concept that growth starts to slow, jobs data slows, the forward-looking indicators of the economy, travel, PMIs, these things start to slow. And at the same time, inflation is not going anywhere. What does the Fed do? It's kind of a challenging circumstance, and a rarity in Fed policy is this concept of stagflation, sticky rising prices. Sorry about that. But at the same time, growth metrics slowing. So what do you think? I mean, I have a thought. I'll share mine after you, but what do you think the Fed does in that circumstance?
I think what we did during, of course I can find it. I wanted to have this one, but if you go to jobless claims, so they're like what 250 now or so.
Mhm.
Back in COVID times, I was hoping for more history, so I went to this one. I'm sorry. But if you go back to COVID times, it shot up like from 1 week to another, like 6,000, like from 1 week to another. When you see high volatility in the jobless claims, because it's a week, it's every week, or if CPI has a dramatic change, but it's also slower. Also, NFP is slower, and also PCE is lower. So I think they will look into jobless claims or anything that is every week and make a judgment call on what would happen to CPI because CPI back in 2020, they made a drastic decision. I think it was 3rd of March and 15th or 19th of March, and the CPI number was only like 10th or 13th, so in between there. So it's too slow for us to be reliable when we have a dramatic change. Secondly, you can also look into the headlines, and you can start calculating how many people who is laid off. Back in 2020, it was everyone almost in the restaurant business or in service industry was basically what do you call them in English? Not let go, but you have like you're told to go home.
Yeah,
but you're getting paid or something. Like
it's furloughed.
Yeah, when the whole service industry that happens to you, then that's a red alert. So to answer your question, I'll probably say data and probably say jobless claims or anything else that I can't remember right now that is posted every week that has to do with labor or inflation.
Yep, fair enough. I think for me, if I was to try and make a pick, I think the first one they would act on is jobs, because inflation is at like 3%, right? CPI, and core PC is at 2.5. So inflation, the target is 2%, but that's their theoretical and ideal situation. It's not like if it is above there, it's all over, right? If inflation's at 10%, that takes precedence massively, right? But if jobs data, right now, I don't think it's at a critical level, like you pointed out accurately. I think you did, that was a great point about unemployment claims is not at like a critical level. But like if jobs were to really start to get critical, like unemployment claims seriously started to jump, I think that's the one they would act on first, because inflation has further distance, I think, to go before it is critical. But right now, I think the Fed is just going to sit there and do nothing. I think that the expectations for a whole bunch of rate cuts this year, 3. I mean, I suppose it's not too crazy, but are all up to what happens with the jobs data. If that claims data, as you just mentioned, starts to peak up week to week, then it is likely, I think, that those rate cuts are going to come in. So we'll see. It's really, really going to be interesting. I think the jobless claims week to week will be really important to watch.
So we are sitting up with the implied volatility rank that I have on Tasty Trader on 51. That is quite high. The last time I saw it that high, that high was with our decline from July to August of last year. We crept up into like the 60s when this market was dumping over the weekend. The one thing I keep looking at is, I actually measured this out just to be, I was curious this morning. Take the length of that decline. Oops, let me use a different color here. Take the length of that decline from July to August and match that from these recent highs, and it's pretty close. So let's grab the measurement tool. That move was around 9.7%. And from the recent highs down about 9.7%, that would be pushing close to like the 55.50 area on SPX. So just keeping a close eye on this. I still go back to, we have April lows, we have August lows. I think this is a pretty good technical spot. The market's clearly trying to flush and test these lows again. I was pretty excited. Like Friday, I was out of the office, but it was nice to see the market closing, higher off the 200 moving average and actually take out the intraday high. But that was just wishful thinking because the market today so far is still flushing a little bit lower back down to those lows from Friday. What do we have on the docket this week? The docket this week, it's inflation week. Now, a couple ways to take a look at this. Of course, I don't know. There's no crystal ball here, but this is in the area that I think the market is willing to show at least a recovery. Maybe it's a short-term bounce. Maybe it's a dead cat bounce. Maybe it is just get the heck out of trouble position. I do have some hedges that are still going, which I'm fine with those. Like that is MES here. A lot of my MES positions. Right now I'm up around $3,700 on some hedges, and I've got an ES trade that's up another $1,600. So I do have some hedges running. I closed out a bunch of my SPY hedges. I closed out my MES and ES hedges last week. I have some fresh ones that are still running out to April and May. So I'm going to keep a close eye on those. I'm selling some premium today. I'm selling some premium out 40 to 50 days. But I want to talk about a couple technical levels. April, August, and we're at the 200 moving average. A couple things, just textbook overbought, oversold conditions. So what I'm noticing here on this is a MACD, is, we are making some fresh lows and we are getting some divergence on the MACD oscillator. We're also coming into some really nice relative strength oversold conditions. So the one thing that's going to be difficult and it might be tough to time, when we had this correction, all we did was we pretty much came down to the RSI 30 level and then started to go back up. I think the hard part is going to be spotting divergence, meaning this: if we go low in price and then low in price, if there's divergence there, then that could also signal a bottom. This week, I think with the lineup of news, it might be a little bit more challenging. A couple things with news this week. Trueflation is a third-party inflation measure, and this did time the market pretty well by showing that when the inflation bottomed back here in September, it started to go higher, and that's exactly what the Fed data ended up following as well. So we had the lowest point of inflation was in September of last year, but since then we had that complete like cluster F of the Fed starts cutting rates and the bond market prices in something very different. And we saw that inflation started to get stickier and higher. We saw 3, 4, 5 months of prints in a row. You can see that also on your Edge Finder. Looking at your inflation data. So if you go to your inflation data, your year-over-year CPI, it's forecasted to be this week. I'll look at the Bloomberg economic calendar. So CPI is going to be the big one for headline readings on Wednesday at 8:30 a.m. Year-over-year CPI, previous print was 3.3, forecasted 3.2, and that's core CPI. So core CPI year-over-year 3.3, forecasted 3.2, and the year-over-year CPI 3%, forecasted 2.9. So the market's looking at a slight improvement. If it is not a bigger improvement than that, I'd be a little bit surprised. This is what I'm talking about. We have seen from the September levels here, Trueflation called that bottom in September, and the market's been going and experiencing higher inflation ever since. So that's 1, 2, 3, 4, 5 prints. So inflation is trending back to where we were back in July of 2023. So, a year and a half ago, inflation's really made zero improvement. Okay. Now, this would justify where the Fed says, inflation is, I don't know if we can use the word transitory without getting in trouble, because that's what got Powell in trouble in the first place. But if it shows that we are actually trending lower again, or getting a reading that's lower, that's probably not a bad thing. So lower inflation, I think, could get the market a little bit more excited this week. A couple things on the technical side. So here is CPI data. Here's core CPI. Okay, and then PPI year over year. And we also have our core PC, which is the end of the month. This is the, kind of the wrong direction we've been talking about. Trueflation calls that bottom in September. There's your readings going up, showing that producer price index year over year is getting stickier, getting worse, not improving. But all of this, from this recent high to this current low, is actually lower than September. So that does make me wonder if, based on where we are at for these year-over-year readings, if we start to see some traction in the right direction. Okay, so that's why I want to look at the calendar this week to see what the forecast is. It's a modest improvement, 3.3 forecast at 3.2, 3% forecast at 2.9. I would say the market this week can get a little bit more excited if it prints better. So if we print 2.8, 2.7 on the year-over-year CPI, if we print 3.1, 3% on the core CPI, I think the market might be a little bit more excited. Technically speaking, this is in a spot where I could see a couple things playing out just price action wise. Either the market, gaps down on CPI news Wednesday and then fills that gap with some opportunistic plays to the upside, or we have a gap higher that has some follow through. That's probably the trick this week. Is I don't think the market's just going to stay, same price, close and open. I think we're going to have some gaps this week to deal with. So I wouldn't be surprised if the market either gaps higher on CPI data and then pushes up, or the market gaps lower on CPI and then fills the gap and then actually has some bullishness. But this is the area that I've been talking about now for the last 30 plus days. Connect your lows. This is a spot that I want to take some bites. Okay, I'm going to take some bites in here and start looking to position myself for a little bit of a recovery.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.